Assalamualaikum and a very good morning. So today my group will be presenting on monetary policy. So let's start with the definition. What is monetary policy? Monetary policy is the government's use of interest rates and supply of money to influence the AD and level of economic activities. So the monetary policy is actually the government which use interest rate and supply of money to influence the aggregate demand, where they control the money supply to change the interest rate so that it will influence the movement of the aggregate demand. So changes in interest rate will affect two of four of component of aggregate demand, which is I, investment, and C, consumption. So let's start with the role of central bank. So the first one is as a banker to government. They act as commercial bank to government, which they sell bonds, they hold deposit for the government, make loans and transfer funds for the government, and also sell bonds in term of borrowing. And they also become the advisor to the government on financial. So the next rule is as a banker to commercial banks. They hold deposit and give loan when needed by the commercial bank, but central bank is not the banker for consumers or firm because the bankers for consumer and firm is commercial banks. So the next role is a regulator of commercial banks. What it mean by regulator of commercial bank is the central bank regulates and supervise commercial banks on how they operate, and they make sure that the commercial banks not abusing the customers' money. So the last one is conduct monetary policy. So as we know that the central bank, they control the money supply so that they can change the interest rate, and they also in charge of changing the exchange rate in order to achieve macroeconomic objective. So let's move on to the money market and rate of interest. In our world, the real world, there are many different rates of interest depending on the number of factors. So the first one is level of risk of a loan, which means that the higher the risk, the higher the interest rate. So the next one is length of period of time over which the loan must be paid, also known as maturity. So the longer the period of loan, the higher the interest rate will be. And move on to the size. So the bigger the loan that have been made, it will make the interest rate higher. And the last one is degree of monopoly power of the lender. So the higher the degree monopoly power of the lender, the higher the interest rate. However, the economist has analyzed things, and they adopting common practice of referring interest rate as a one. So move on to the next one, which is money supply. So money is defined as medium for payments in purchasing goods or services. It can be by the firms or the consumers, and they consist of currency such as coins, paper money, and check. And they also includes deposits, loans, and credit accounts. The money market is a market where the demand for money and the supply of money determine the equilibrium of rate of interest, which means that the intersection of demand and supply of money in the graph will give the equilibrium rate of interest, and the horizontal rate axis measure the quantity of money in the economy, and the vertical axis measure the rate of interest. As you can see in this graph, the horizontal one is the quantity of the money, and the vertical one is the rate of interest. And the rate of interest can be the price of money and services, which means that the vertical axis is indicate the amount of money that need to be paid after borrowing the money, and it shows the relationship between the rate of interest and the quantity of money demanded, and has the familiar downward sloping shape of a demand curve. As the rate of interest falls, the quantity of money demanded by the public, which are consumers, firm, the government, increases. As you can see, from the SM1 to SM2, the interest rate falls, and the quantity of demanded by the money increases. So the supply of money is fixed, which is perfectly inelastic because it is decided by the central bank, and it is appear as a vertical line, SM, because it does not depend on the rate of interest. And the point of intersection between DM and SM, as I said earlier, determine the equilibrium rate of interest. The intersection of SM1 and DM will give you Q1, which is the rate of the equilibrium quantity of money and the equilibrium rate of interest. Does the central bank control the money supply or rate of interest? When the central bank conducts monetary policy, it can focus on controlling either the money supply or the rate of interest. Of course, making a decision on one automatically determines the other. Central banks in many countries used to try to control the money supply. However, growing difficulties in effectively doing this led central bank in many countries to abandon the focus on the money supply and to control the interest rate. So when the country they try to control focus on the money supply, let's say from uh, I1 to I2, they wanted to decrease the rate of interest. They need to increase the money supply from SM1 to SM2. Sometimes they abandoned the focus on the money supply and they had to control the interest rate instead. So the central bank decided upon a target interest rate it wants to achieve, like I said earlier, from I1 to I2, and then take steps to adjust the money supply so that the actual equilibrium interest rate will become equal to the target interest rate. So after they set the target from I1 to I2, they need to control the money supply, which in this case they need to decrease the supply money from SM1 to SM2 to achieve the I2, which is their interest rate target. As I showed earlier, this point is what I said earlier. So in the real world, the rates of interest have many. There are many interest rates, which differ for each central banks of each country target. Like for Bank of England, they targets the best rate, and for the United States, they targets the federal funds rate, and for the European, they targets the minimum referencing rate. In the conclusion, central banks cannot control all, but they only can influence the interest rate that will influence from I1 to I2, but they cannot completely control all the interest rate to become I2. So changes in interest rates, as the increase in interest as interest rate increase, this will cause the cost of borrowing to increase, and therefore it will lower the consumer spending and the investment from the firm. Also, therefore, it will decrease the aggregate demand and it will shift the aggregate demand to the left. Let's move on to the type of monetary policy. First one is expansionary monetary policy, or it is known as easy monetary policy. So it occurs when there is a recessionary gap appears in the graph of macroeconomic due to the insufficient of aggregate demand. So when the central bank recognize this problem, they will try to increase the money supply and reduce, and therefore it will reduce the interest rate. And when the interest rate is reduced, therefore it will reduce the cost of borrowing, and it will promotes the consumer and firms to increase their consumer spending and investment, and therefore it will increase the aggregate demand, and the aggregate demand will shift to the right. However, in the classical model, there is smaller increase in real GDP and a larger increase in price level compared to the Keynesian model. As you can see in the Keynesian model, where the aggregate demand shift to the right for when the aggregate demand increase, there is only a partial increase in price level, but more increase in real GDP. But this is vice versa for the classical model, where the price level increase higher compared to the real GDP. So an increase in the money supply by the central bank is referred as easy monetary policy. It is also an expansionary monetary policy. So the objective of this expansionary monetary policy is to expand the aggregate demand and also to increase the level of economic activity. So let's move on to the next type of monetary policy. So the last one is contractionary or tight monetary policy. So when an inflationary gap appears in the macroeconomic graph due to the excess of aggregate demand, the central bank will take the action to decrease the money supply, and therefore it will increase the interest rate. When the interest rate is increased, the cost of borrowing will also increase. Therefore, it will make the consumers and firm to lower their consumer spending and investment due to the high cost of borrowing, and therefore it will lower the aggregate demand, and the aggregate demand will shift to the left. As in the case of fiscal policy, if the aggregate demand fall within downward sloping part of the aggregate supply curve in the Keynesian model, the effect on price level and real GDP are similar to those in the monetarist or classical model. As you can see, 82 decrease to 81 in this sloping part. It will show the same effect, which is decrease in, which will show the same effect to the classical or monetary model, where the real GDP and the price level decrease is same as the monetary and classical model. But if the aggregate supply were to decrease into the horizontal part of the aggregate supply curve, this part, there will be a larger fall in real GDP and a smaller fall in the price level in the Keynesian model. So when let's say there will be a new aggregate demand curve like here in the horizontal part, which is this, there will be more decrease in real GDP, which is this, compared to the classical model, and there is only slightly changes in the price level. That is what it means by that point. So a decrease in the money supply by the central bank is referred to the tight monetary policy, or also known as contractionary monetary policy, as the objective is to contract the aggregate demand and also the level of economy. So in conclusion, monetary policy is actually carried out by the central bank, which has the aim to change the interest rate to influence the component of macroeconomics, which is consumer spending and investment of aggregate demand. I'm sorry, actually the component of aggregate demand, not the macroeconomic. So when a recessionary gap occurs, The central bank may pursue an expansionary easy monetary policy through lowering the interest rate by increasing the money supply. This this type of action is being carried out to encourage consumer spending and investment spending, in, as the objective being to shift the aggregate demand curve to the right, which will lead to the equilibrium at the full level employment of real GDP. And when in an inflationary gap, the central bank can pursue a contractionary monetary policy by implementing higher interest rate, which can be done by lowering the money supply, which they aim to lower the consumer spending and investment, which will cause the aggregate demand curve to shift to the left, which will lead to equilibrium at the full level of employment of real GDP. In a nutshell, the central bank increase the supply of money and it will lower the interest rate, which will lead to lower cost of borrowing money, and it will promote the consumers and the firm to increase their consumption and investment spending, and therefore will increase the aggregate demand, and aggregate demand will shift to the right. And for the contractionary monetary policy, the central bank will decrease the supply of money, which will lead to increase of interest rate, and therefore increase the cost of borrowing, and therefore it might demotivate the consumer or firm to decrease their consumption and investment spending, and therefore will decrease their aggregate demand, and in the end will make the aggregate demand curve shift to the left. And that's it for the monetary policy. So let's move on to next is inflation targeting. So what is inflation targeting? It is a monetary policy that aims at maintaining a particular targeted rate of inflation. So there is several countries that use inflation targeting, such as Australia, Canada, Brazil, Chile, and European Union. So what is actually inflation targeting? So when the central bank is committed to pursuing the inflation target, it is free to determine what policy tools it will use to achieve it. CPI and CPI basket are taken into account to target inflation. So to increase the inflation, the central bank will use expansionary policy to lower the interest rate, and therefore it will increase the aggregate demand. And next, to decrease the inflation, they need to lower their AD. So what they use is they use the contractionary policy to increase the interest rate, and it will lower the aggregate demand and thus lowering the rate of inflation. So the next is the pros of inflation targeting. As you can see, when the government do inflation targeting, it will achieve the macroeconomic objective, which is a lower and more stable rate of inflation, and also improve the ability of economic decision makers, such as firm and consumer, to anticipate the future rate of inflation. And it will also give the greater coordination between monetary and fiscal policy. And lastly, greater central bank transparency and accountability. However, there is the cons of inflation targeting, such as the reduced ability of the central bank to pursue other macroeconomic objectives. The next is reduced ability of the central bank to respond to supply side shock. And next one is reduce the ability of central bank to deal with unexpected events such as financial crisis. And it also will give difficulties of implementation and also finding an appropriate inflation target. So that's it.